you're back in the markets. Why choose to make the switch from active management to indexing?
I learned from my own personal experience that the wave of asset flows is into passive. And if you want to get back into this business, for me, that was the right selection. It's just a ship that has turned. And there have been predictions of when flows would actually revert back to active. Those predictions have come not true. And so I view this as really the wave of the future.
So that moment has passed and we're in a one-way direction here.
In my opinion.
Okay, so your company put out its first index, which is a U.S. large cap index. It's called XOUT, and it is also tracked by an ETF with the same ticker. It's got a pretty impressive backtest, but I mean, to be honest, most funds have a pretty impressive backtest as well.
Agreed.
What specifically is the strategy here?
So we just take the bottom 250 companies and the largest 500 U.S. companies and exclude them. And we use a certain number of fundamental factors for how we come to that exclusion decision, but we're really only focusing on excluding losers as opposed to picking winners, which is what most of the active world is engaged in doing.
That doesn't sound like a recipe for doing well. It sounds like a recipe for avoiding making mistakes rather than picking something that will take off.
Well, the criteria all stems around technological disruption. And I view the most important forward-facing risk for all investors and companies is technological disruption. If you are not spending on technology or dealing with the risks associated with companies who are spending, who are competitors to you, you're putting yourself in a difficult situation to recover from that. It may be too late to rebound and catch up. So the criteria surrounds that theme of technological disruption.
All right, so among those companies that you've excluded include AT&T, Exxon, Verizon, IBM, Disney. Why these particular names? For instance, what's the argument that Disney is not spending enough and is failing to keep pace with technological change and therefore is vulnerable to disruption?
Which is why we don't let one factor be the determinant for what would exclude a company. And in the case of all 5 of those, they have scored through our screening process poorly, and as a result are on the bottom 250 of our ranking system and get excluded. It may be that as Disney's spending starts to fuel revenue growth or other metrics that we use to evaluate these companies, it will get back into the portfolio as we rebalance on a quarterly basis.
So this is rules-based. Is it active in any way?
The active component of this is the creation of the index. And I think, talking to your colleague Eric, it's a very intuitive thing of what he said, that the active component of what we're really doing in the passive investing industry is creating these indices, which have rules which you stick to no matter what. And that's one thing I learned that's very important. So the rule does provide for an ability for a company, if its investment performance improves, to get back into the portfolio.
All right, just to quote Eric a little bit more, he likes to call index making the new active.
Yeah.
So this is essentially backing that idea up.
Totally agree with him.
All right, we've given Eric plenty of love here.
Really?
I want to broaden out a little bit here and talk to you about some of the pitfalls that we've seen with active investing, because a lot of times when we've seen with active is that when funds invest in illiquid securities and assets, they can't sell them when they absolutely need to. And we've seen this happen with Neil Woodford and GAM. Most notably. How widespread do you think this really is at this point?
You know, look, liquidity risk is an important risk factor for a lot of different funds and different strategies. I think it does depend entirely on what the underlying securities are. In the case of XOUT, you're talking about an index that's focused on the 500 largest companies. These are theoretically the most liquid companies to trade on public exchanges. So that's one of the most important ways in which we're mitigating that kind of risk. Clearly, if you're in a concentrated portfolio of distressed credit instruments, there's a different liquidity profile of that underlying portfolio.
Given where we are in the economy, late cycle and all that, do you think we're going to see bigger blowups in funds in coming months?
No, and you know, I've been on the show in the years past, and that's always a question that comes up, and here I am 4 years later, and it's still the same question, and we haven't had any real blowups. So I think the market structure is pretty sound, and ETFs are really a superior product, in my personal opinion, just coming from the mutual fund industry. It's a superior product that eliminates some of those liquidity concerns that might exist in particular mutual funds, not the entire industry of mutual funds.
Okay, so that tees us up perfectly for our next point, which is you're uniquely qualified to talk about the worries over fixed income ETFs not having enough liquidity, a liquidity mismatch. HYG, for instance, trades an average of $1 billion a day, but many of the bonds in the fund don't trade regularly. Is this worry valid, that liquidity mismatch?
No, I think that, and if you've seen certain sectors within the HYG that are part of the index, go through their own separate dislocations, whether it's energy or media or telecom, and yet these portfolios continue to function. There has been no true real market disruption. Individual securities might price down, and then there'll always be a market for that. It might be at a distressed price. But within a broad portfolio like HYG, which is wildly diversified, we haven't seen that problem occur, even when there's a sector breakdown.
So is this concern different than with liquidity mismatch within a fixed income mutual fund?
Well, it has to be. It depends upon, right, what concentration levels that mutual fund engages in. And if they're a highly concentrated fund, then they better make good security selections.